GDP numbers are out today. Were they in line with what economists were expecting?
So GDP, the economic scorecard for Australia, actually came in a bit weaker than many economists were expecting. 0.3% growth last quarter, an annual rate of 0.8%. But the devil is in the detail on these figures, and as usual, growth in some areas of the economy was greater than in others. So for some analysis of the data, let's speak to Adelaide Timbrell, a senior economist with ANZ, who joins us now live. Adelaide, welcome. Thank you for your time.
Thanks, hello.
GDP growth of 0.3%, but a drop on a per capita basis. What do today's figures tell us about the state of the economy, rather?
Yeah, look, population growth has been a huge part of economic growth in Australia for some time. And this is the 7th quarter where we actually see that per person economic activity has reduced. And when we dig into the detail of the data, what we're seeing is that it's government spending which is actually creating economic growth. And if we take out government spending, the private sector, so the rest of the economy, is actually going backwards. Now, part of this is because of how the national accounts or the GDP data treat things like rebates. The electricity rebates have really reduced household spending, but they've added to government spending because that's kind of how it flows through the data. So it's not all bad news, but we are seeing that households did not increase their spending over the quarter. We didn't buy any more than we did last quarter, even though there's more of us, even though we had a little bit of wage growth. The biggest upside, I think, in the data is that the household savings ratio went up to 3.2% from 2.4. Now, this was actually revised upwards from previous data as well. So when we look through the history, we're seeing different numbers than we did last quarter, and it's telling us that households actually have more money and more savings behind them than what the data previously suggested. So this is telling us that the average household is a little bit better off than what it looked like last quarter.
Okay, that's good news. So we're saving rather than necessarily spending that money. So you were just talking there about the government spending. So how big a factor was that? It sounds like it was quite a significant factor in this GDP growth in the last quarter.
If GDP was just government spending, it would have gone up by 0.6%. But once we add in the private sector, it went up just 0.3%. Now, government investment in particular was a real driver of growth. We saw government investment up 6% over the quarter, which contributed 0.3 percentage points to GDP growth. So it really was all that infrastructure investment we're seeing. In any kind of city you're in, you're going to see that construction going on, that engineering construction, and that's also going to continue. It's the story we've had all year, and it's the story we expect to see through next year as well. Lots and lots of government spending. Whereas the private sector is a lot weaker. So commercial building activity in the private sector is very weak. A little bit more in the housing construction, which is really great to see given there is a housing shortage in many capital cities. And then absolutely nothing going on in household consumption, which looks to be a result of people saving their tax cuts and saving a little bit on electricity.
Now, because growth was overall weaker than most economists expected, does this increase the case for an interest rate cut?
Usually, a weak economic growth quarter would increase the risk of a rate cut depending on other factors. This time around, it's a little bit more nuanced than that. So yes, there was that weak headline activity, but on the other hand, what we're seeing is much stronger household finances than what we saw in previous data. So on the one hand, you're kind of saying, well, households are actually better off than we thought, so maybe we don't need to cut rates and we can see if we can get inflation lower. On the other hand, the economy is barely growing. So it's going to be a real confluence of factors. Overall, what we did see, which is a really encouraging sign for rate cuts, is that unit labour cost, so the cost of an hour of work, did decelerate. So we're not seeing as much inflation there, which means for businesses, they're getting more bang for their buck than maybe we expected when it comes to an hour of work, and that means there's less inflationary risk. The more it costs to hire and have people do the work, the more it costs for those products at the end of the road as well.